Thank you all for staying for the second panel at BGov FinTech. We've put together a great lineup of experts to talk about the ways that financial technology is reshaping not just the way that we bank and do transactions, but also economic opportunity and hopefully increasing financial inclusion. We're also going to talk about kind of finding that right balance between regulation, innovation, and consumer protection. So I'm going to let each of my panelists introduce themselves very briefly and kind of give a quick cap on their relation to FinTech, and then we'll move into a discussion. Go ahead.
Great. My name is Chris Brummer. I'm a professor over at Georgetown University Law Center, where I teach securities regulation, financial regulation, and I also organize Washington, D.C.'s FinTech Week, November 5th through the 8th, dcfintechweek.org.
I'm Jarrod Loadholt. I'm Director of Legislative and Regulatory Affairs at Credit Karma and a former Senior Counsel in the House Financial Services Committee.
Makada, Henry-Nickie, Rubenstein Fellow over at Brookings Institution. There, a lot of my work focuses on access to credit, lending discrimination. Before joining Brookings, I was at CFPB, just digging in.
Ernie, I'm the Deputy Chief of Staff for Congressman Gregory Meeks, handle his Financial Services Committee work. I see some of my former colleagues from the Conference of State Bank Regulators. That's where I came from preceding my current role. Spent some time at Senate Finance after law school.
Robert Meloche with Visa. I head up our financial inclusion work here in the U.S., as well as work on a variety of our global programs to help underbanked, underserved populations. Some of that work is with fintechs that we partner with, often actually combining fintechs with credit unions, community banks, trying to get an outcome in that regard. My background before Visa, I was in the nonprofit microfinance sector. So those micro loans that were just being talked about on the last panel is actually most of my background.
Thanks, guys. So pretty diverse perspectives. And I forgot to mention, I'm Lydia Bayoud. I'm a FinTech reporter here at Bloomberg Law. Makada, I'd like to start with you. Can you give us a sense of when we talk about and think about financial inclusion, what should we be thinking of? And then the others feel free to jump in.
So when I think of financial inclusion, so three core ideas come to mind, and they're not mutually exclusive. On the one hand, it is increased access to affordable, high-quality financial services and products, but that should also come along with increased education for unsophisticated consumers, and then thirdly, increased trust, right, in the financial service providers and the regulators that ensure that they're acting responsibly. So I'll share a quick story. The other day I was at the post office waiting in line, and I encountered an older gentleman, and I'm nosy, so I'm chit-chatting about why are you here? And so it turns out that he's very comfortable getting his paycheck as a direct deposit, using that debit card for his daily expenses, but he doesn't trust his bank to send off his monthly car payment. So he treks to the post office to get this money order instrument that he really trusts. And so when we talk about financial inclusion, giving him a payment app or a new way to make that payment doesn't deal with the core underlying mistrust of both the system and the failure of regulators that will bring him into the fold and sort of change him from being underbanked. So when we talk about financial inclusion, for me, it really has to be policies and products that are holistic in order to be truly impactful.
Jarrod, go ahead.
To me, I think financial inclusion is how can we ensure Americans make progress no matter where they start? How do you understand your financial life? And I got in this work in part because I grew up in a really rural area where I think for the average person that I think we grew up with, was check cashing, it was title loans, and occasionally a bank, but banks were usually places where you were turned down. And it was that experience that I think motivated me to get into this work. And it's one of the reasons why I work for Credit Karma, where part of our mission is helping Americans make financial progress, no matter where you start. So if you start at a credit score that's in the 400s, how do we help you build that credit? And given that your credit score, and this is your credit profile, here's what's in it so you can understand it. If you're looking for a credit card or a personal loan, here are the terms and conditions you need to know. And here's how you can comparison shop across products. So for me, financial inclusion, I think, is fundamentally about how can you help people make financial progress no matter where they start.
And go ahead.
Go ahead, Ernie. No, please.
No, I think that's a great point, Jarrod, and there's a lot of good research being done right now by the Center of Financial Services Innovation, and they're focusing on consumer health. So not only are they looking at access issues, but they're looking at the outcomes of financial consumers and the products they use and what kind of financial situation those products and services put them in the long run. I think, especially if Democrats take over the House, I think you will see a more focus on that in addition to access. But how do we get folks to a better place financially in terms of health, financial health?
So I'd like to emphasize a really important point that we just heard. Often when you think about financial inclusion, the debate certainly has traditionally focused on the question of capital access. And just to share a story, just 2 weeks ago, I was over in Bogota giving a keynote on financial inclusion, where the idea of financial inclusion isn't just capital access, but for their particular situation, how do you include former guerrilla fighters into the financial system without promoting narco trafficking? Very specific form of financial inclusion. But what's important about that is that financial inclusion is in itself a political idea, but ultimately is grounded in this concept of how do you get people to participate in the financial economy fully in a way so that they in turn can participate in economic growth and in the real economy, right? Because there's a connection between the two. And capital access is one of those categories. It's an important category, but it's certainly not all of them. Financial inclusiveness is how do you get the bridge liquidity from one paycheck to the next, insurance, healthcare. And this concept of financial inclusion should be embedded into the way in which we think about regulatory policymaking. And I think that one of the challenges before us is just how do you operationalize that?
Yeah, to pick up on that example from India, actually, so not with former guerrilla fighters, but with women cotton farmers. I was just in India 2 weeks ago visiting one of the projects we have, and these women have access to a bank account that's been a priority of the Indian government, and there's pretty much universal access across the country. They don't have the sort of functional access, right? So often the men in the family are controlling access to the account, hold the PIN. And even just access the account isn't enough. It's how do they generate income and wealth. And so the principal financial vehicle we're using is actually, in this case, a farming cooperative, and organizing these women into cooperatives so they have greater buying power. They can negotiate better interest terms. And so it's not with a traditional sort of bank model. It's customized. And I'd say that, to me, the answer is it depends on the situation, whether that's Colombia or India. Here in the U.S., it's really not about unbanked, as we have around the world. It's about underserved, and what was just being shared. Nearly half of all households of color are still making use of payday, pawn shop, auto to auto, and these other sort of alternative financial services. And so you have to stop thinking about accounts, and it's how do we offset the use of these alternative services and make sure people are able to build wealth over time to ultimately close that racial wealth gap in the U.S. That, to me, is the ultimate goal that we're trying to get to.
So I think you've all touched on different facets of how to approach financial inclusion. I think follow-up is, so in the U.S. at least, what can be done to either offer those products or think kind of holistically about a political and social and economic model? I mean, is that sandboxes? Is that more partnerships? I don't know. Jarrod, do you want to tee off?
I think the answer is all of the above. So, for example, I think on the question of sandboxes, I think they can be helpful, but I think fundamentally it's still, I think, where consumers don't necessarily understand what their options are. And I'm not quite sure if a sandbox gets us kind of where we need to be, such that the person who is thinking about whether or not they open a bank account or go to a check cashing place, I'm not sure a sandbox answers that question for them. Or if they want to know between, should I get a subprime credit card or go get this, this payday loan, I'm not sure that Sandbox answers that question. I think Sandboxes help companies, and I think it can help, make your compliance headache, I think, a little less burdensome. But I think, again, to the point around financial inclusion and getting the right products for you, given your station in life, I'm not entirely sure that gets us where we need to be. What I think, quite frankly, is that's kind of a market play where we find ways to get information in front of consumers in the format that they want it, in a way that they understand. And I think you have people like NerdWallet, for example, that help inform consumers about how they can make the right choice. I think there's a role for people like the Googles to play when people search payday loan, right, or small dollar loan, whatever they call it, such that, maybe there's a gatekeeper role where we make sure that there's certain products people see and don't. I think some people would have really strong views on both sides. But I think, again, if we're talking about people being able to access high-quality, responsible credit, I think a lot of the conversations that we're having in D.C., unfortunately, don't answer that question, which I think that might be an answer that the market may be better prepared to provide, given that they're the ones that are interfacing with consumers every day. And I think there are players in the market that are doing that. Obviously, I work at Credit Karma, so I obviously think we do that. But there are a lot of companies, I think, that are trying to figure out ways to get better information, I think, in front of consumers. Because there is a high cost of poverty. And I think we've got to find creative ways, I think, as industry players, to reduce that cost of poverty for people who are trying to find responsible, quality financial products.
So I think you're exactly right. And I want to extend and offer alternative solutions, alternative data, as a potential solution. Now, I say it with cautious optimism. So when I think about alternative data, an old Ethiopian proverb that my mom used to say comes to mind. When you pick up one side of the stick, you also pick up the other. So there are upsides, I think promising upsides to the use of alternative data, but there are some downsides because of how this business vertical is structured that we ought to sort of really think about. So there's new research sort of really focusing on the peer-to-peer market. Lending Club, thank God, and Prosper are making their data publicly available. So we get some insight as to what's going on. And when you begin to drill down, researchers are showing that on the one hand, you can expand access to credit. And how does that occur? Well, what they're showing is that borrowers who were mistakenly denied credit can now get access. There are some issues associated with that, but I think that's a good takeaway. Secondly, fintechs are showing that they're able to price credit in a much more precise way. And so not even just for folks who were denied credit before, imagine that you had a bunch of credit and you just really couldn't afford going through responsible, high-quality products. So P2P loans and in this kind of vertical is showing promises, some really great upsides. I'll add that for unscorable and thin file borrowers, the mere presence of a new P2P product, because it kind of looks like a credit card, is a reliable signal to traditional banks that this is a good credit risk, right? So now for 26 million people, which the CFPB just scored, there's hope. So all of that sort of upside I'm very excited about. But the other side of the stick, how do they get this done? So the experimenting, so going to market to figure out how do we provide access to credit, and that comes from the use of, I think, of expanded algorithms, right? So let's kind of think about what that means. That means you're enhancing traditional credit models and scorecards with pretty provocative variables for people like us coming from a regulatory background. Your professional occupation. Are teachers and doctors more likely to have stable, higher incomes than a janitor? Objectively, yes. And these are the kinds of variables that we have to begin to open our minds to see what the potential is. And that's probably where a sandbox might come in, right? So there is use of geographic variables, but we don't have insight. We don't know how these models are using it and definitively if. But we're seeing that we're getting some of the upside from it. Now, here's the other piece. On the investor-lender side, in that vertical, investors/lenders can pick which kinds of loans they choose to fund. And when you blend those kind of criteria, and you fractionalize the loan notes, what you get is the thing that we like most. More people can now qualify for loans that they can afford. In that sort of scenario, and adding AI-driven marketing models, what begins to worry me is the potential for discrimination, digital redlining. And because what the P2P model is showing us, that discrimination is good for business, but is which kind are we willing to accept?
And in addition to that, the upsides you mentioned, one other big upside that we are happy about, the research has shown that these lenders are filling gaps in areas where banks have pulled out since the crisis. As we all know, branches are closing at an alarming rate, leaving banking deserts and whole communities with unmet financial services needs. So, for example, in our district in Jamaica, Queens, 34% of individuals with bank accounts also use alternative financial services, whether that's check cashing or pawn shops or rent-to-own arrangements. And that studies from those numbers are from a 2015 Urban Institute study. So in addition to a lot of the upsides that were mentioned, that's something that we think is a positive development. To address some of the downsides, however, I think Cordray at the CFPB created a model that could have potentially allowed us to better study potential discrimination related to alternative data. Unfortunately, the political situation associated with the CFPB now is one in which I don't think we are getting the information that we need, that we could have gotten. Which is unfortunate. But I think that there is a model for better understanding these products, and the Cordray CFPB put that forth via the Project Catalyst No Action Letter regime. Hopefully, we could get someone at the CFPB to take that up and move forward in a way where we could get better information. Also, I'm generally in Washington, studies are a way to delay action, but however, I think there needs to be a lot more studies in this space. Yesterday, Congressman Meeks introduced the bill related to open banking and data aggregation, which is another issue we've been following.
Do you want to define open banking?
Yeah, so it's the whole idea of banks allowing consumer-authorized third-party access to data. There's a question as to whether or not the banks own the data or the consumers, and how that information should be shared, and if it can be done so in a safe and sound way, or a way that avoids cybersecurity risk. I think Europe has shown some leadership in that space from a regulatory standpoint. Our regulators haven't weighed in as much as CFPB under Cordray has, but not our safety and soundness regulators. So our bill would instruct them to do so. And I think more studies like that is definitely helpful for us to really understand some of these issues, that these potential downsides that could have harmful effects on communities that have been disproportionately hurt by or harmed by crises, including the most recent financial crisis.
So we, go ahead. Yeah, we took a run over the last year and a half at this problem, trying to create sort of our own private sector sandbox to play in addressing particularly credit access. And so we worked with a group called the Filene Research Institute, which is a leading think tank in the credit union space. And we wanted to try to combine FinTech ideas and actually and products with more traditional lenders. And so we had 40 credit unions around the country test out a variety of credit products, from payday alternatives and payday consolidation loans, micro and small business loans. We had an auto refinance product, because of course auto lending, the rates people are paying on cars is just astronomical in some places. And we had 5 products in that mix that we tested over a 18-month period, with all of those intended to drive access for households of color. And speaking of reports, we just put out a report about a month ago on all that information. So that's an example of a sort of sandbox where we're saying, okay, here's what we tested. Some of it, by the way, didn't work at all. The auto refinance thing just fell flat on its face. We're not sure why, because that was one of the ones where we used a FinTech. We used a data mining company in combination with the credit unions to try to better understand who in their membership was into high-priced auto loans. But ultimately, the credit union just couldn't get past that underwriting hurdle at the end of the day. Other products like the I-10, or individual taxpayer ID lending, if you're familiar with that, this is lending for immigrant households who, whatever their journey in towards citizenship, they don't have a Social Security number yet, but they can still not only open accounts through an I-10, but actually receive loans, as I-10 being one of the know your customer underwriting pieces. That was one of the most successful programs we had in that, and also working with LexisNexis, which some of you are probably familiar with, their risk view score, which is one of these alternative scores. We use that in combination with trying to get people out of payday debt and to consolidate those loans. So some good learnings across the board. All of that is public. That's about a 100-page report we put out about a month ago on all the findings and the financials and the interest rates and what was charged. And we're hoping that credit unions, community banks around the country will take up some of the best models and serve a broader base of the population. The last thing I'll say on the alternative data, I think it was Congressman Meeks that referenced it. The industry has been patting itself on the back about using rent payments now, and as if that was some progressive idea. Congratulations, 30 years late, but you're well done. So some of the alternative data is actually just the data you already have, and this is the thing we've tried to encourage credit unions. You know your member better than a fintech. Like, you understand who that person is. And I think, again, it was the congressman who was talking about how he received a loan from the person he bought the house from. And one of the products in there was called QCash, which is from a credit union up in Seattle that uses member-based underwriting, which is basically just looking at the data you already have. Instead of surrendering your underwriting to FICO, and we mentioned the credit invisibles and the people have insufficient data, recognizing, look, I know a thing or two about this member, about this customer. How can I use my own set of data, maybe informed by other things like LexisNexis, to make better crediting decisions instead of just going, oh, you don't have a score, sorry, you're out, or your score is subprime, sorry, you're out. Taking a look at things like employment, deposit, with a relationship to the bank or credit union. So those are the things we've been playing with for about 18 months, and all of that's available at filene.org if you're interested in that report.
I think one of the ironies that you just described was looking at your own members, looking at your customers, and making a decision that used to be called banking. Likewise, if you look across different industries and sort of upstart industries, people are like, wow, Uber has a really radical idea, actually picking people up regardless as to how they look. And it's amazing what kind of market you can have. I think that the regulatory sandbox idea is one that, just like any, depends on the details. Regulatory sandboxes have an interesting history. They're tied originally to the United Kingdom. Increasingly, it's tied to this idea of Brexit and how do you attract foreign market participants to your borders and how do you keep them there. Project Catalyst with the CFPB had a very innovative way of thinking about regulatory sandboxes as, on the one hand, granting upstart companies more flexibility in terms of the rollout of their products, but underneath it all was an idea that's becoming increasingly clear amongst the banking regulators as well as the market supervisors that financial regulation is increasingly data regulation in some form or another. And that data regulation can just be from a cybersecurity standpoint. Data regulation can be in terms of access to data, in terms of barriers to entry for upstart firms into more mature industries or industries where certain players as incumbents tend to enjoy more data. But it can also be a form and a mechanism for data creation. It's true that we don't have the banking challenges that Colombia may have. But at the same time, we do have problems of those who are underbanked, underserved, and what often happens pertaining to our own digital infrastructure, where a lot of the alternative data that is being created is tied in some way or another to the internet, that just by dint of who you are, you may not have as much reliable data that's being generated about you, and as a result, that can create barriers to entry for new entrants or upstarts or historically disadvantaged peoples into this very interesting marketplace. And I think that when you want to design a sandbox, you have to think about not only the regulatory burden question, which can be important, particularly for new companies that may not have the resources to enter into new markets, but you have to think about the market supervisory questions to make sure that people get information. Now, again, by definition, usually in a regulatory sandbox, the supervisors are paying closer attention and talking a little bit more to the participants in the regulatory sandbox. But finally, figuring out a way to produce data, usable, utilizable data within the regulatory sandbox to help to enable a greater entry for underserved people into these services. And I think that that's something that regulators, policymakers, and the FinTech and financial communities really can find some aligned interest in trying to achieve. And then, I do a lot of international stuff. Many of these services are cross-border just by dint of the nature of the internet, and figuring out a way for different regulators and different sandboxes and the like to share their lessons learned. Because I think that we could certainly learn a bit from interesting techniques deployed in other parts of the world, whether or not it be India, whether or not it be China, whether or not it be Africa. So I think there's a lot of potential, but it does require study and analysis. But it's not a problem that can't be solved with the correct amount of attention.
Well, I think you all have touched on the importance of the primacy of data in finance. Ernie, I want to go back to the issue of open banking, but have the rest of you weigh in too. With what we've seen in the European regulations, PSD2, on banks and granting third-party access to consumers' accounts and letting consumers have more control over their data, is it too soon to sort of judge whether that's actually resulting in beneficial products, new services for consumers? Do you think that we need something like what they have in Europe here? Should we just leave it up to the markets?
Yeah. I wouldn't go as far as to say we should replicate what's in Europe, but I would say that this is an issue where study is necessary, because if this is a potential way of allowing folks to better manage their finances, I mean, that's a no-brainer. We should be encouraging that activity. So, like I mentioned, the bill that we introduced yesterday directs the safety and soundness regulators, because we saw principles from the CFPB, but it directs the safety and soundness regulators to look at this issue from a cybersecurity, anti-money laundering aspect as well. And hopefully we could get something eventually passed then, or even if we don't get the bill passed, we could kind of encourage them to get some information back to Congress on how we should best regulate this issue. We even noticed, and this is kind of unrelated, but the friction between banks and fintech firms, we even saw that between a EBT related app that helps consumers manage their SNAP benefits, and the federal contractor that manages the EBT program in a large amount of states,
including Congressman Meeks states,
was potentially, including New York, was potentially setting up roadblocks for this app, which has helped many in our constituents help better manage their SNAP benefits. So we weighed in on that issue. I think it parallels a lot of some of the issues we've been seeing between banks and these apps as well. The good thing, though, however, without regulation, some firms, some banks, and some apps or fintech firms have been coming to resolutions on this issue, and I think that's positive. We've seen some good recent reports about better sharing between these institutions, and I think that's a positive private sector development, that maybe we don't need a regulatory regime like Europe, but we should at least study that.
I think it would be useful just to put out there and for folks to consider, even outside of open banking, how does one think about financial regulation, right? There's a way in which I teach financial regulation. I teach it to my students all the time. But I was over just before Bogota in Brasilia for a FinTech meeting by the Financial Stability Board on there was a financial inclusion sort of debate, and there was a certain way of looking at things. And when you understand what financial regulation is, it's important to really grasp the concept of tools in the toolbox. And there are lots of tools that haven't been deployed, weren't deployed during the financial crisis, that can integrate either very quietly in a way through methodologies, but also through your perspective, how, for example, financial inclusion can be a macroprudential stabilizer. How in times of financial turmoil, a more diversified set of participants in the economy can help you ride through certain kinds of rough patches. How, obviously, a greater participation in GDP growth can lead to more sustained economic growth, right? And when you look at not just the banking and open banking systems, but when you look at everything from aspects of banking regulation, capital regulation, monetary policy, things that you don't normally immediately attribute with financial inclusion, a more sophisticated and holistic approach can help to kickstart some of the other initiatives that are happening on the ground. And I would hope that as time goes by and people take their retrospectives over the 2008 financial crisis, and as you think through sort of next steps given the challenges facing really full and equal participation in GDP growth, that people reinterrogate and rethink just literally how we design the financial system and how we operationalize the rules that we do have. Because I think that there are ways where people can find consensus, inspiration, and new ideas that have not sufficiently come to the attention of market participants and regulators.
I'll take it a step further. I think open banking is a positive first step. But in terms of consumer data, when the rubber meets the road, there's usually some issues, I think Ernie pointed out, between a bank and an aggregator or another third party where the bank decides that this is their information and not a consumer's. I think that a rights-based approach, almost like a consumer data bill of rights, where we clearly establish that a consumer owns their financial data, which should be pretty self-evident. But if you have a few conversations, and no offense to any banks in the audience, but when you talk to enough banks, they may not say it publicly, but privately there is a view that they own your data, or at least they act as if they do. So I'd be a fan of kind of a consumer bill of rights where we clearly, I think the CFPB took the first step with principles, but I think a rights-based approach where I think step one in your financial freedom is owning your data, knowing where it goes, and I think that's where we get to privacy regulation and so forth. But step one is being able to control your data and having a right to control your data, and you being the ultimate arbiter of where it goes and how it goes, because that's not quite how things go now. And I think open banking starts that conversation, but I think short of a rights-based approach, which makes it clear to all the players in the ecosystem that that data begins and ends with the consumer, I think we're going to be having this conversation again 5 years from now. So Ernie knows I'm not shy about telling him what I think Congress should do. And I think that would be kind of a welcome in terms of what a FinTech agenda looks like. I think one that's in part consumer-centric, where they control their data, because the data ultimately, I think, is the value. If I think most companies would be honest, I think they'd say that there's value in knowing where that data is. But I think it starts and ends with the consumer. So I think a rights-based approach is something that I think Congress should seriously consider. I know some conversations have happened, but I'd like to see those continue to move forward.
Yeah, and I think around the conversation of open banking, this is a perfect space for either a sandbox or collaboration, right? Open, interactive, dynamic conversations with FinTech and banks. Because the other thing that we're not sort of appreciating is there's a tension when it comes to access to all of the transactions and all of our financial lives. FinTechs disproportionately have the upside when it comes to benefits. They reap the most. Banks hold the cost, the liability, because if I'm transacting through PNC and something happens, I'm going to PNC, bank, I provided XYZ, you had some sort of arrangement, now I'm hurt, I need you to make me whole. That's a real cost for the bank, and that puts them, that sort of motivates different kinds of equities in this conversation for them versus FinTech versus consumers, and regulators ought to be a part of all of this, trying to honestly navigate some sort of compromise. So I wouldn't want to, go to any extreme about over preordaining what kinds of uses or just leaving it up to the markets completely. But we have to find some sort of effective middle road today and be proactive about it than just kind of wait for this to play out in a court. And we've seen some really sort of critical cases being decided in courts throwing, I think, monkey wrenches in the way that we thought FinTech would be developing, questioning P2P models, questioning money transfer and mobile payments.
Yeah. I think if we were to have this panel a few years ago, it would have been called Bank versus FinTech, right? And I think the good thing is, I think the conversation has moved past that. Now it's about collaboration, how do we work together, and we're seeing examples of that. And just one I'll mention as well, I think it's also important to bring the nonprofit community into that FinTech bank conversation. One of the interesting initiatives the last couple of years from Aspen and Ernie and the Federation of Community Development Credit Unions is called NLIFT, and it's about trying to actually do FinTech innovation within the communities that they serve and actually bring in innovators and technologists that are actually people of color, and some of what the Congressman was talking about earlier. But I think it's important to have that voice in the mix too. It's not just a technologist, not just a bank, but it's also really the community-based organizations that understand the needs of these consumers.
Thanks. So in the few minutes we have left, I want to see if there are any questions from the audience. If anyone is interested, there's some microphones going around. Otherwise, we'll continue discussion. Oh, sir.
Hello. Mic check, mic check. All right. Thank you all for coming. My name is Damian Savage. Work here at Bloomberg Government. My question is, where do we kind of define exactly what a fintech company is? Because I think about Facebook, you think it's like, oh, social media, but I can send money through Facebook. There's Apple, which is this huge technology company, but there's Apple Pay, and I can move money through there. So, like, where do we define exactly what fintech is, or is it completely going to be that gray area? Because there's always going to be technology, and there's always going to be money, and as we move through the future, I feel like it's going to forever be joined together. So, just your thoughts on other companies kind of getting into passing money between consumers and different businesses.
I think if we consider fintech to be technology-driven financial services, then we've always had fintech because you've had banks offering ATMs and other technologically driven products and services. I think the catchphrase, though, however, I think folks are referring to the startup industry, especially based in New York and Silicon Valley, and I think there's some popping up in the South as well. So I think there's two definitions. I think that generally speaking, we've always had technology driving financial services, and so a bank could be a fintech. But I think there's a second definition that refers to that startup industry.
I think that the term disintermediation is very frequently associated with fintech. And I think it's appropriately associated in some ways, but it's also even more appropriate in other situations. Now, the traditional concept is by deploying technology in a certain way in the financial space, you're disintermediating incumbents who have been the traditional providers of financial services, whatever they may be, banking, insurance, look at crypto when you get into finance. From a regulatory standpoint, very often, however, those incumbents who are being disintermediated are also the gatekeepers that the regulators themselves have traditionally relied on in order to supervise markets. So, if through certain kinds of token sort of crypto offerings, you don't need to sort of register anymore, then you're not only disintermediating investment banks, but you may be disintermediating the 33 and the 34 Act, right? That by offering your services on a platform, you may be trying to circumvent the CRA, right? But at the same time, there is an operationalization of the existing technology itself in an innovative and new way. It doesn't always have to be sort of purposeful regulatory arbitrage, but it can also, you can just have a new kind of product that allows something to do that either is encompassing new kinds of data, new kinds of information, faster, easier. And as a result, you think about financial technology, I think more and more and more in terms of sort of spheres in the ecosystem, right? P2P, sometimes you'll get into cloud, sometimes high-frequency trading, sometimes you'll get into crypto, you can get into all kinds of different microfinance, into different segments, but with an understanding that these two developments are being driven, that you have incumbents who are not necessarily leading the way, which creates uncertainty, but also opportunity. And then even from a regulatory side, you're trying to figure out how do you define, if they're posing your question, since it's falling outside of the normal financial system, how do you define the activities and the services that are themselves being offered?
And so I'll add to Chris's question. That's exactly the question I think we, in my previous regulator life, are struggling with, right? So as fintechs sort of come in and they're disrupting or sort of changing the way we transact, we're now recognizing there's value to like old segments we hadn't paid attention to before. For example, money transfer. So I spent a lot of time working on LP4, the money remittances rule. And after 18 months, and I'm now transitioned, I'm looking at PayPal playing in the space, Asimo, these brand new players, and thinking back, man, we had not foreseen this 24 months ago. So now we have to probably sort of think back and go back to those rules and sort of figure out, what's the outlier now? How much are we not catching? So the fact that, we're thinking about fintech and these regulatory questions ought to be linked together, kind of really, we need to sort of step back and think about what kind of regulatory updates do we need to consider today to help us navigate these uncertain times moving forward. The banking sector has been declining for 33 years. Consolidation, failures, whatever. And in the mix of that, you've got consumers shifting across all demographics and increasingly becoming more comfortable with these digital products. So fintechs are here to stay, whether they're in this form or some other, but we have to find a way to sort of navigate and keep our macroprudential indicators safe and solid, as well as making sure that all consumers can fully participate. We cannot do that with fintechs us talking here, and none of my CFPB or OCC faces familiar in this crowd. We have to sort of like figure this out and figure it out now. The costs are way too high for ordinary folk for us not to be able to get a grasp on this.
Okay, we've got less than a minute left. I'm going to go quick flash answers from you guys. So we've got midterms coming up. No one knows what the makeup of the next Congress is going to look like, but what is the one fintech issue or financial services issue that you hope, Congress, whatever it is next year, will get to? Chris.
Okay, when you said midterms, I said, no, I don't have to give exams anytime soon.
Not those midterms.
That I hope that they'll get through any honestly speaking, and it hasn't been mentioned here, but if you're just going to ask me in terms of the health of the country, before I even get to, is just cybersecurity, because I think that that's there are enormous potential risks to our financial and digital infrastructure regardless that are troubling. Now, when it comes to the financial inclusion conversation, I'm intrigued by thinking about the open banking question and finding some kind of clarity there, as well as applications to the CRA by some of the fintech companies.
Go ahead.
Okay. I'd say data security as well as data portability and consumer data rights.
I would put on the table that it's high time that we update the Equal Credit Opportunity Act and its implementing rule, and that necessarily invokes CRA, the Community Reinvestment Act, not just for banking actors, but for fintechs as well.
Yeah, so my boss is generally supportive of the charter proposal that came out of the OCC, so long as there's strong financial inclusion requirements associated with it. But there is legal uncertainty associated with that whole regime, so it may behoove Congress to provide more certainty in that area when it comes to non-banks applying for federal charters, whether that's a special charter, ILC, or
Yeah, I would say the first panel echoed this, but we're moving to a minority country, and if the rates of inclusion don't change, we're going to have half the country underserved, underbanked by 2045. And so I feel like we have to address that collectively through government, through private sector, through the NGO sector, to try to close that gap. I think that has got to be the clarion call of any new administration.
Okay, well, thank you so much to all of our panelists. Thank you all for coming. Have some more coffee.